Just when you thought things couldn't get any crazier, the S&P 500 is up 1%, leaving the bears, economists, and strategists bewildered, recording another new all-time closing high above the 5,600 area. And this was all on the back of Taiwan Semi. Their June numbers beat expectations, giving semis the gas they need to rally. And when semis rally, technology stocks rally. And when tech stocks rally, passive index effects kick in and everything rallies. And that's what we saw today, with market breadth looking better than ever. But in a world where valuations look extended, where can we find value? Today, I'm going to show you the best sectors that look cheap and will also deliver outsized returns against the S&P 500 in the next year, 5 years, and 10 years. And we're also going to talk about earnings, guidance and revisions, as well as headwinds for this earnings season. We're also going to dive into the consumer and what our expectations are for the S&P 500 for the rest of July. So is it time to hedge, or do we have more gas in the tank? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. It really helps me out. Let's get into it. This is the daily heat map of the S&P 500, and last time I saw this much green, I was chilling in a forest. Green everywhere except a couple of very key names. We saw Visa and MasterCard take it on the chin in this section here of financials. This has to do with some of the words that Jerome Powell said yesterday with regards to banking regulation. It's going to seriously affect Visa, MasterCard, and just credit services as a whole. Other than that, very green across the board, including defensive sectors. Look at consumer staples, stuff like utilities, even healthcare. Today was equities risk on, led by the technology names, Nvidia, semiconductors, Broadcom. They were the biggest winners today, followed by Microsoft, Apple, Google, Meta in close second and third place. Even Tesla and Amazon slightly in the green, but they actually underperformed the broader discretionary market. And we saw broad-based buying action across the board because TSMC, Taiwan Semiconductor, they released their June sales figures. And then when you put the June figure together with the last 2 months, you actually get the full second quarter figure. And that is at plus 40%, handily beating the market forecasts. And this set a fire under pretty much every sector except software. They were the only sector that was down today. IGV down 0.04%, but everything from financials all the way to semiconductors were green. Sectors that outperformed the SPY were materials, technology, home construction, regional banks, semis, and gold miners. We got into gold miners here on the 1st of April. We must be up 15-20% since that day. But sectors that underperformed the SPY, XLV, healthcare, utilities, industrials, pretty much everything else really was just risk on. But it wasn't just the TSMC news. There was a bunch of other factors affecting the market. The first was that yields fell. The 10-year yield was actually down 0.47%. The 30-year bond also down 0.5%. In fact, the 2-year yield as well down 0.9%. So yields across the curve actually fell, and that helped the smaller names like mid caps up 1.21% and the IWM, which was up 0.98%. We also saw a fall in the dollar. After 2 days of upward momentum, the dollar fell 0.1%, and that helped the larger names like the RSP up 0.82%. The S&P 500 gained 1.02% on top of the TSM news, and the Nasdaq 100 also up 1.09%. As a result of yields falling, we saw bonds gain. The TLT was up 0.3%, actually forming a higher low and looking to take out these highs right here. If we could break the 95 area, it's up and away, looking at 100. And when bonds are a bit up and yields fall, commodities tend to be upbeat. Gold was up 0.31%, silver up 0.14%, and crude up 1.22%. But on a peak to trough basis, you're looking at a 2% gain here in crude, bouncing right off the $80 level and looking very strong after that bounce. But let's talk about the S&P 500. Another new all-time high, and the S&P 500 has gained 18.73% this year. Year to date, kind of crazy. This actually doesn't include dividends. Something else to note right here, this is the advanced decline line. It's the amount of advancing stocks in the S&P 500 versus the amount of declining stocks divided by the actual S&P 500 index price. And it allows you to plot the advanced decline line similar to what the index looks like. And generally speaking, if the S&P 500 hits new all-time highs, you want the advanced decline line to hit all-time highs. That means that the advanced decline line is actually confirming the highs in the S&P 500. Now, we made a new all-time high in the advanced decline line here at 1508.68. The current advanced decline line is at 1508.81. So a new all-time high in the advanced decline line, and market breadth has actually confirmed the move upward. What we do want to see is further momentum here in the advanced decline line, and not just like a complete unwinding of breadth, but things looking very, very good. And looking at the RSP, it does look like this 162 line is probably going to be the low, and I think we're probably going to move higher. What the RSP really needs to do right now, though, is go ahead and make its way to the 166, break above, find support right here, and then continue the move higher, looking at like the 169 and then the 170 new all-time high level. But this price action is looking very, very constructive. We are in this range right here, and we're either going to break above or move below. Based on what we're seeing with the S&P 500 and earnings, I think a move higher is more likely than a move lower. But the S&P 500 new all-time high, we're actually above the call gamma resistance. The call gamma resistance is actually right here at the 5600 level. Let's actually mark it out more precisely. That is the call gamma resistance. Now, I said yesterday that we could find a bit of price discovery above the call gamma resistance, but most of the time when we do get above here, we actually do see a little bit of a pullback back to the 5600 area, but we have broken above. So it's very likely we're probably going to find support at the 5600 area here in the S&P 500, and then we'll make our move higher. We can see a little bit of price discovery below the 5600, but the gamma flip zone is right here at the 5500 area. So if we are to pull back, this is probably where we're going to find support. I do think we'll find support first at 5600, but if we do break below, then we can see some downside to the 5500 area. The levels are very, very clear, but momentum brings momentum, and you want to be buyers of dips. We've said it so far, and if you haven't held equities this year, the S&P 500 up 18%, you've really missed out. But where can you actually find value in this market? Now, something that I've noticed, small cap quality, right? Look at something like the CAF index. Year to date, if we actually pull up the year to date chart on a percentage level, down 10%. I think small cap quality, being a bit of a dumpster fire this year, is about to make a very, very big move higher. Now, this is actually the Pacer small cap cash cows. If we look at the Invesco small cap quality ETF, not quite as much of a dumpster fire, only down 3% so far for the year. But I do think that small cap quality, mid cap quality stocks are about to make a huge move higher. So I do think that if you are looking for value, getting in at some of the highest quality names at something like a 14 or 13 forward PE at these levels right here, very, very good, great long-term returns. And you're literally looking at companies that are growing earnings at 10%, return on invested capital at about 25%, and have extremely low leverage on their balance sheets. A lot of cash, very little debt, and they should outperform in the very, very long term. But you know the goal with the S&P 500. You want to be buyers of dips at the 5600 area. You want to be buyers of dips at the 5500 area. Personally, if we do break the 56 area, I'm not going to take shorts to the 5500 area, because we can find support and start rally anywhere in between this 100-point range. So just buy dips, sell rips. And really, if you've been following this channel for a while, we've been long equity since the start of the year. You should really be long. You should just be holding and taking all the gains you can. I do think we're going to go higher. 58, 5900 should be the end of your target. And also, guys, something I've told you guys for a while now, the second we get into overbought conditions, right, like we have right here, yes, we may see some short-term sell side, but if we stay in the overbought conditions for a while, it normally just means we tend to see higher price action in the medium term. And this is exactly what we're seeing right now. So yeah, we could see a little bit short-term pullback, but staying in overbought conditions is actually more of a bullish indicator than it is a bearish one. Looking at market sentiment, this is CNN's Fear and Greed Index. And despite markets at all-time highs, we are still in the neutral zone. We've been in the neutral zone for quite some time. 1 month ago, we were in the fear zone. And normally speaking, when market makes highs like it has in the last couple of weeks, you'd think we'd be in the extreme greed zone. But this indicator is heavily dependent on market breadth, and market breadth's been a bit of a dumpster fire. Now, with sentiment at neutral, markets at all-time highs, what exactly are fund managers buying? This is both as private clients and what they're essentially buying. So let's actually just exclude the total, right, and ETFs, and just have a look at the individual sectors. The overwhelming majority of weekly flows are into technology, consumer discretionary, home services. So essentially Google, Meta, Microsoft, Apple, Tesla, and Amazon. So the Magnificent Seven. That is what fund managers are buying. And you can see there's a little bit of buying here in staples, materials, utilities, but virtually inconsequential. The majority of funds are going into the Magnificent Seven the last 4 weeks and in the last week. And this just goes to show the breadth dynamics in the market right now. With that being said though, how exposed are fund managers? This right here is the NAM Exposure Index. Pretty much tells you how exposed are US fund managers to US stocks We're sitting at 103.66. Essentially, that means fund managers are 3.6% levered to US equities. This is the type of stuff you see in bull markets, but this isn't necessarily a contrarian signal. In fact, this is often a bullish signal because you can see right here from this data set, the NAM exposure index, when it's greater than 100%, what are the returns we can expect from 1 week to 12 months later? And the returns are quite stellar. You can see right here, 2 months later, we can see returns of 2.3% in the S&P 500, 4.8 3 months later, 8.2 6 months later, and 15.3% 1 year later. So essentially, fund managers are long and leveraged long often means they see further upside, and momentum brings momentum. So you do want to stay long, buy the dip if we do get any, and just hold because outsized returns tend to occur when we do get the NAM exposure above the 100 level. So guys, we're going to dive into earnings because Q2 earnings season just started. We're going to talk a lot about earnings over the next couple of weeks, and we got some very, very interesting data and a note here from Buffett. Now, this is 2024 EPS. It's revision trend, and we are tracking a typical non-recessionary year. You can see this is 2024, what we're doing this year, the historical average, and then all years excluding COVID, the GFC, and then the 2000 bubble, and then 2025. Now, typically speaking, the S&P 500, as you can see right here from the historical average, earnings get revised down about 8 to 12% leading up to the earnings season. We can see right here in 2024, we are tracking a typical year without a recession, well above the historical average. That is why the S&P 500 is so resilient in the face of, weaker economic data. As long as earnings hold up, the S&P 500 will hold up. And if you actually have a look at Buffett's estimates into 2024, we are actually set to see upward earnings revisions into the end of the year. And Buffett do expect Q2 earnings to actually come in pretty solid. In fact, they expect a 2% beat. They say corporate America delivered a strong beat in Q1. Earnings per share topped consensus by 3%, 6% including BMY's adjustment. That was of Karuna Therapeutics. The consensus expect plus 9% year over year in the second quarter versus 7% in the first, or 10% ex BMY, against an easier comp of negative 6% year over year in 2023 second quarter versus negative 3% in Q1. We expect a 2% beat plus 11% year over year in line with the historical average and the smallest beat since the fourth quarter 2022. So both expect earnings to come in great this quarter. They expect earnings to remain robust in 2024. However, it's not without headwinds. Even though we are getting better guidance and better revisions, the US dollar or foreign exchange is still a 100 basis point headwind. You could see here that in the second quarter or this earnings season, foreign exchange impact to year-over-year sales growth is going to be 100 basis points or 100% at the top line, which is significant considering that S&P 500 revenue estimates are sitting at 4.6%. Without the foreign exchange adjustments, we probably will be looking at about 5.6, maybe 5.5% around that area right here, with the biggest contributors to this being materials and technology, seeing the overall market impact being 1% here in the second quarter, with every single sector having a massive FX impact, including utilities of 0.1%. So a stronger US dollar will have a major impact on earnings, and that is the price you pay for greatness. Now let's switch gears and talk about market breadth. This is a chart that's been floating around Twitter. I showed it to you guys last week, and it just shows that in 2024, 25% of S&P 500 companies are actually beating the overall index, which is some of the lowest levels we've ever seen here in the index. On average, it's normally anywhere from, I would say it's very close to 40 to 58% at the very top end companies beating the S&P 500, which is more average. So pretty much a very small amount of stocks is really driving the majority of gains in the index. Now we got a note here with regards to market breadth from the Lethal Group. They say from a technical point of view, 1999 is the only analog for the breadth collapse within the S&P 500, like we've witnessed recently. Since the 5th of June, the S&P 500 has posted 11 52-week highs, yet all of them occurred with fewer than 50% of the index's stocks closing above their 50-day moving average. Prior to last month, there had only been 19 other times since 1957 when the S&P 500 peak came on such narrow index breadth. It's no surprise that several of those were in the late 1990s. By the time the index had climbed to its tech bubble peak in March 2000, the percentage of S&P 500 stocks trading above their 50-day had jumped to 64%. It's a reminder that only rarely do stock markets fall apart when it looks the most vulnerable. Quite often there's another thrust higher that bewilders the skeptical economists, strategists, and chart watchers. It's been the bear's way of maximizing the number of occupants before the elevator goes down. Now, just to relate everything back to earnings and the biggest stocks in the market, this right here is the Nasdaq, right? So essentially, you're looking at Apple, Microsoft, Google, Nvidia, Meta, the biggest stocks, essentially their earnings and the price. And you can see right here in 2024, this has been the market earnings and this has been the market price. They've moved in tandem despite the breadth we've seen in the market. The reason why we're actually getting a bit of breadth discrepancy has to do with the fact that the broader market earnings hasn't been there. They've been pretty much flat, while the Magnificent Seven have increased. Whereas you look back to 1998, early 2000s, look at the price and look at the earnings, flat to down. And this is the difference between 2000 and what's going on right here. Earnings are backing up price here in 2024. Now let's talk about the macro. This right here is the United States Red Book Index, and it actually increased 6.3% here in July. And this pretty much tells us that the consumer is in a very, very healthy position. The Red Book Index is a sales weighted of year-over-year same-store sales growth in a sample of large US general merchandise retailers representing about 9,000 stores. So with this moving up and to see an increase of 6.3% in the week of 6th of July, this is very, very positive and tells us that the consumer is still hanging in there. But we are starting to see some early signs of deterioration. This is non-farm payrolls in 2024, the first and latest reported figures. So essentially it just tells us the revisions in non-farm. So for example, you can see in January, we initially reported 350,000 in non-farms. With all of the revisions we've seen, it's now at 250. So we've seen revisions here in February. We saw up revisions in March, which is very, very interesting. Continue to see downward revisions in April, downward revisions in May. And then this is the latest June print. And I would probably expect this to go down as well, but anything can happen. We can actually see upward revisions like we did in March. But what you also do have to understand is that despite all of these downward revisions, these are still above the consensus expectations. But the labor market is deteriorating because since mid-2023 here in July, the unemployment rate has ticked up to 4.1% from the 3.5% level. With that being said, the SARM rule remains below its recessionary threshold, and pretty much when the 3-month moving average of the jobless rate rises by at least half a percentage point from its low during the previous 12 months, then a recession has started. So pretty much when it's above this line right here, a recession has started. We are not there yet, but we are very, very close. If we keep seeing stuff like downward revisions in non-farms and we start missing the consensus expectations, then we're going to have a real problem and we would technically be in a recession according to the SARM rule. And if the labor market cracks, all hell breaks loose. And for all of the bullish momentum we're seeing in July, this is actually completely normal. This is S&P 500 seasonality, first and last 10 sessions of the month. And we can see right here, average return, median return in the first 10 days of July tends to be very, very positive, 1.55 and 2.07% respectively. When we actually look at the last 10 days, very similar situation, while not quite as upbeat. Median return 0.46, average return 0.11%. So despite the price action we're seeing here in July, history tells us we can actually go higher. But based on the average return, we normally actually digest the gains we see in early July. Then we actually get into August right here. The first 10 days and the last 10 days of August tend to be fairly lackluster. And again, that's probably because we are digesting the gains we've seen throughout the first half of the year. And in July, we see very lackluster returns, average and median 0.22, 0.03% in the first 10 days, and 0.18 and 0.1% in the last 10 days. The only negative month we see tends to be September, average return negative 0.32% in the first 10 days, 0.69% in the last 10 days. And that is just a dip buying opportunity because October, November, and December tend to be very, very bullish across the board. Now, looking at data, tomorrow we have CPI data, the year-over-year, month-over-month figures for headline and core, and the expectations are as follows. For the year-over-year figures for headline and core, the expectation is 3.1% and 3.4%. Then month-over-month figures for headline and core, the expectation is 0.1% and 0.2%. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.